Hello, I'm Rachel Jones for the Finance News Network. Joining me from GARDA Diversified Property Fund is Executive Chairman Matthew Madsen. Matthew, welcome.
Thank you very much.
First up, if we could start with a brief introduction to your company.
Sure, thank you. So GARDA Diversified Property Fund holds about $300 million of assets under management. These are commercial and industrial properties located along the eastern seaboard. The fund has 9 properties, a market capitalisation of about $160 million. Gearing for us will long term sit between about 30 and 35%. Predominantly these assets are located in Queensland and Victoria, about 55% to Queensland and 45% to Victoria, and 70% commercial and 30% industrial.
Now to your first half 18 results. What were the highlights?
Sure. So the first half 18, a number of really great operational events that occurred during that 6 months. So occupancy in our portfolio increased from 93 to about 97%, and you'll start to see that impact of revenue mainly in FY19 rather than second half FY18. Also, we've acquired a new property in Melbourne, the Tenant 9 project, and this is a new build for us, delivering 7,200 square metres of commercial office into one of the tightest office markets in Australia, with about 2% vacancy. Outside of that, from a distribution perspective, our payout ratio is in the low 90%, it's about 91.5%, and so we've been very pleased with the first half for FY18.
And to your portfolio, can you tell us more, starting with your tenant profile?
Sure. So our top 10 tenants represent about 64% of our income. Many recognisable names amongst those. So Blackwood & Sons is our largest tenant, representing about 11% of income. Blackwood is an industrial safety business, a wholly owned subsidiary of Wesfarmers, but been operating for over a century. We have state and federal government amongst our tenant base as well. A number of recognisable businesses such as Golders, a global engineering business, Fulton Hogan, New Zealand construction infrastructure business, and outside of our top 10, many recognisable brands in 3 of the banks, NAB, Suncorp, ANZ, professional services businesses like BDO and Grant Thornton. So a very diverse spread of industry type and a very strong base,
Can you tell me more about the types of properties and location?
Sure. So the types of properties, as we said, are commercial and industrial. We only invest along the eastern seaboard, as far west as Canberra perhaps. We're very much focused on investing in real estate markets with very low incentives. So you'll see we have a concentration of commercial properties in Melbourne, whereas our industrial assets are more predominantly based in Queensland. In terms of our assets, there's a combination of newer, longer WALE, longer leased properties, and a combination of things that require a bit more active asset management. So whether it's a repositioning and a reinvestment program such as our Cairns commercial building, or whether it's building buildings from the ground up such as our Tenant 9 project in Richmond in Melbourne.
And what are your key metrics?
Yeah, so key metrics for us, what keeps us focused is maintaining our balance sheet, so nice conservative gearing around 30 to 35% is our longer term view. Currently we have net debt of about 25%. We might operate up into the 40s from time to time. Predominantly metrics that people wish to focus on is distributions and payout ratio. And as I said, the first half payout ratio was around 91.5%.
Thanks, Matthew. You have several projects in construction. What stage are they and how will they complement the existing properties?
So we have 3 projects in construction, 2 in Brisbane and 1 in Melbourne, as we've spoken of. The 2 in Brisbane are both industrially focused, and each of those should be finished around the middle of the year. One of those projects is a soil recovery and recycling facility. This is largely a hard stand project and is co-located near the Brisbane Airport and Seaport. Conversely, Volvo Trucks Australia's new national headquarters is being constructed out at Wacol, so very good transport corridors and distribution from there. So each of those buildings about the middle of the year. The third building, Tenant 9, is a project that's commenced construction late last year when we settled on the site, and that building should be finished about this time next year. So a combination of industrial and commercial to complement the balance of the portfolio, and from our perspective, properties that are being delivered in very low incentivised markets, which is extremely important for us.
Last question, Matthew. What's the guidance for the second half of 2018?
So guidance for 2018 will again be 9 cents per unit. Current trading price, it's about a 7.8% yield coming out of our fund. And importantly for investors, 50% of that is tax deferred.
Matthew Madsen, thanks for the update.
Thank you very much.